Joshi, Head of Equity Research at William O'Neill. Thanks so much for joining me today, Mayuresh. And I do want to ask about the first stock. Now, Tata Motors, a lot of people had raised concerns based on the performance, both of the domestic business and because of the kind of geographic spread of JLR. But based on the recent update for the quarter ended September, they've said that short-term deposits rose by 300 million pounds sterling to 3 billion pounds in that quarter, and that reflects positive free cash flow during the quarter. And they also say that China, which opened up a while back, is seeing encouraging signs. And on a sequential basis, sales are up 50%. But the key concern of margins, I think, would still remain. I know a lot of analysts said that the first quarter should not even be considered, but would you start looking at the numbers now in July, September and start, analyzing what is to come and the key watching points for you?
Morning, Alex. Thanks for having me on your show in the first place. No, you're absolutely right. I think Q1 possibly can be one quarter which can be assumed to be one quarter which can be an exceptional quarter at best because of the pandemic issues at large. But largely, again, I think consistency is something that we look forward to, right? And whether this consistency is expected to get maintained over the next few quarters, very difficult to say that. But at least I think as a trend over the next few quarters, the next couple of quarters, if this trend is maintained, that gives us the confidence that business is back. Yes, the numbers that have come so far, I think the China numbers specifically in terms of sales which have happened thereof, both for Jaguar and Land Rover as well. I think that's very, very encouraging. The short-term deposit which have risen and the cash and cash equivalents as well, I think that's a positive sign as well. But let's understand that they've taken a huge cash impairment hit in the last fiscal gone by. Secondly, I think with the diesel emission norms in Europe and the emergence of electric vehicles and the capex related on that front, I think there'll be substantial cash outflows for this part of developmental activities for these business subsegments as well. How North America holds up and how Europe holds up in terms and view of competition will be extremely critical for the stock. So the stock has given a huge move. If you probably look at how the markets have behaved, how Tata Motors has behaved right from April, May, I think the move has been pretty stellar from the low levels that it had achieved. But now the markets ideally will like to see consistency in numbers delivery. So I think as per our own ideology, I think the EPS rating, the relative strength rating and the overall master score will be dependent in terms of delivery of both volumes, realizations, bottom line growth on a consistent fashion. Whether that comes through, I think the numbers will tell the story. So I think it's a wait and watch for us for the sector as a whole, Alex, at this point in time. I think two-wheelers relatively look better placed in that.
Okay, very interesting. And I was just going to ask you, so good thing that you pointed out that that's a wait and watch. So Tata Motors key numbers to watch out for still in the works. But HDFC also came up, Mayuresh, with a quarterly update. And I thought, we spoke about, Credit Access Grameen yesterday. And of course, it's a microfinance lender, but HDFC, completely different space. The word that is coming in seems to be positive, So individual loan approvals for one rose 31% on year in July, September. You had total dispersals rising 11% and loan applications gaining 12%. But interestingly, what they say is that they saw the highest recoveries in September since the onset of COVID-19. And they have assigned loans worth 3,000 crore to HDFC Bank compared with 7,000 crore. And they're saying that the gross income fell 70% to 323 crore. What do you make of those numbers? And what, according to you, is key to watch for HDFC? Would you still buy at this point?
You're absolutely right. I think it's an encouraging sign, right? Ever since the lockdown, what has happened and transpired in Q1 and the unlock activities which have now begun, economic activity is coming back. And that's clearly getting reflected both in terms of numbers exhibited, not just by the auto companies that we are just displaying on a month-on-month basis, but even recoveries that has probably been seen in the financial space as well. The moratoriums have gone down for the industry as a whole, compared from Q4, Q1 to Q2. So in that respect, yes, I think the positiveness for the sector continues. But I think for the greatness to come, I think the price improvement, Alex, has also got to come through. which is still missing in HDFC. Yes, the numbers have been very, very encouraging. What they've also done in terms of buffering their balance sheet, in terms of provisioning, I think the provisioning that they've got at this point of time, at least till the end of Q1, were close to 2.5% of loans, close to almost 11,000 crores. And that, in my opinion, is sufficient enough in terms of taking care of any assets which go bad. The underwriting skills have been fabulous, so there are no two ways about it. And what they've probably done with their deposit franchise as well, I think the NIMs and spreads have been maintained across time cycles. So the kind of cash flows that they generate, the asset quality, though I think a little bit under stress in the last few quarters, is still right there because of the excess provisioning that they have created. But I think for the greatness to come through, in our opinion, and the leadership on the leaderboard stocks that we've got at O'Neill, I think price improvement has to come through, which is still lagging and missing for a stock like HDFC. So unless that comes through, I think the confidence to probably get into the stock doesn't come through. So let's wait for numbers. Let's wait for the management commentary that comes through. If that gets substantiated and the price strength starts coming back into the stock, maybe we'll have a look at that at that point.
Interesting. Because side by side, you've actually seen a stellar up move. I think we spoke about it recently. Bajaj Finance has moved significantly, right? Anyway, let's talk about the third stock. Britannia is the stock that I want to talk about. And it's an interesting announcement that came in. You know, they are looking to reward shareholders, they say, in an unprecedented time, in a tough environment. They're saying that they're going to give a dividend of 12.5 rupees per share. And they're also going to give one unsecured non-convertible redeemable debenture of 29 rupees per share held. And that's coming from the reserves. They're saying that they have substantial buffers that they don't need immediately for business. And they say that it's a strong cash flow business, so they can generate more. The question is this a good move in the context of the times, right? So a lot of businesses say we would like to keep our powder dry. That doesn't seem to be the case with Britannia. How do you rate the move?
Well, Alex, I think the cash flows remain extremely strong for all these companies, right? So I think if you look at their cash flow generation, the cash flow from operation and the free cash that they generate, because I think the business that they're into, biscuits, within that, I think the premiumization part of biscuits portfolio, the dairy business itself, the international business as well. I think the free cash flows are very, very strong for a company like Britannia, which is exhibited by the balance sheet. So I think it's a good move to reward shareholders. I think no two ways about it. Even if it means depleting a few of their cash reserves at this point of time, I think it's a positive sign that they're indicating to the market that we will reward shareholders who have been with us. Now, the other element in terms of the business growth itself, I think what has got transpired in Q1, I think the supply constraint issues which were plaguing a lot of these FMCG related stocks, I think most of those issues are behind them at this point of time. Secondly, I think the distribution pipeline and the direct supply chain is ramping up as well. And even the weak states within North India, where the presence was very, very minuscule, I think the presence has started improving because of both these factors at play. The third element, obviously, for these companies becomes how do they estimate their input costs and what happens in terms of the EBITDA margins and the operating leverage as well. The input costs probably a little bit on the higher side, with the milk prices going a tad bit higher, sugar prices expected to move a tad bit northwards as well. But I think a pass-through is largely expected, and with demand and volumes expected to come back, the leverage should start playing on their balance sheet as well. So yeah, I think it's a strong counter. Valuations have always been on the higher side. But yeah, I think this counter is one counter as per our cancelling methodology, which we'll keep on our buy watch list.
All right. Well, it ticks all the boxes. Thanks so much for joining me today, Mayuresh.
Thank you so much.
And have a great day as well. And to you, dear viewers, have a lovely day and hope that you have a profitable day. Do stay tuned. There's a lot more coming up in just a short while on Bloomberg Quint.